Good evening, ladies and gentlemen. Welcome back to Walk the Block, where we are navigating digital finance all together. I am your host, Zenith. It is a pleasure to see you guys as always. We got a good show for you here tonight with one of our favorite topics that we love to talk about. The Federal Reserve did have one of its semi-quarter, twi-quarter, what's the word I'm looking for? Twice a quarter meeting. Yes, thank you, me. Yeah, and yes, we did get a quarter point rate cut. We're going to be talking about what that means. But more importantly, there's another little tidbit that happened during the meeting that we're going to be paying attention to as well and breaking down, giving a little bit of a basic course on what exactly does the Fed do with all the money that it has. I know we also the meme clip where the guy says there's a near infinite amount of money at the Federal Reserve, and it's fun to meme on, but at the same time, we'll break down what exactly it could be referencing and how that could have been said a lot better. But outside of that, we also have some updates on the job market, and then we also have updates on the market, the one that we actually care about because we're all inside the crypto sphere here. That being said, I am joined by an excellent cast of characters here tonight. But first, I got our buddy Dace. How you doing, my man?
I'm well, sir. Keeping very busy. But yeah, glad to be here.
Excellent. And we're also joined by Tracker. How you doing?
Doing good, man. As always. Let's get into it.
Absolutely. Let's get into it. So let's start off the show hot off the we're just gonna right into it tonight. First up, let's go look at our documents. All right, from the desk of the Federal Reserve themselves. This came out on the 29th, aka last Wednesday. So for us, we're a few days behind the cycle, but that's just because we stream on Mondays. Never to fear, though. I think we're actually seeing some of the effects play out as it stands today. Anyways, let's get into it today. In support of its goals and enlighten the shift in the balance of risks, the committee, the Federal Reserve Committee, decided to lower the target rate for the federal funds rate by 1/4 percentage point to 3 3/4 to 4%. In considering additional adjustments to the target rate for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee decided to conclude the reduction of its aggregate securities holdings on December 1st. The committee is strongly committed to supporting maximum employment and returning to its 2% objective. Well, there you go. That's a lot of words there. What does it all mean? Quarter point rate cut. So interest rate over at the Fed goes down by a quarter point. Hopefully that also translates to the other interest rates across the nation and sometimes the world that are actually based off of that. Additionally, they have decided to conclude their reduction of securities holdings, aka it's their other tool that they have. They're going to stop the buying up their, they're going to stop selling off their securities holdings, which also translates to the end of quantitative tightening. That can be one of the clips we're looking at today. And we'll give an explanation on that one in particular. And then lastly, the balance of risks. Yes, as it stands right now, jobs are the main risk that they're looking at instead of inflation. So we'll be talking about that in our second news story as well and try to figure out what is going on with Jerome and why he's doing what he is doing. Gentlemen, at a glance, are we surprised?
No, not at all. I think we've covered Jerome Powell quite extensively over the course of the show and over at our sister channel, Degen Roundtable. I think the name of the game here is, is Powell's consistency. Powell is in the position he's in, and he has a track record of reliability and of a steady hand. So he is known to telegraph his moves out ahead of time, and this has not really broken any of that pattern.
Well said. Tracker, were we betting on this one?
No, we knew they were going to do a quarter BIP. We already knew that. we knew that was going to happen, and we knew that there's going to be another quarter rate BIP coming up in December. It's going to happen. I just wish that Jerome would have just shut his mouth about the whole. Well, nothing's. He just couldn't. Like we all everybody was saying, he just couldn't help himself, could he? Just had to put it out there.
What did he put out there, Tracker? What do you mean? I think you're hinting at him saying that they may or may not cut in December, right?
Yes. He just had to say that. Like it's not. Everyone's expecting it to be a given. It's not necessarily a given. Man, just shut up. Just take your 1/4% hike and just go with the flow and just stop. He just can't help himself. It's so frustrating, man. Because the whole markets are gonna hold on every little word he said. Best off, he should say, play the middle ground. We're going to do like we've always done. We're going to wait for the data to come in, and we'll make our decision based off the data going forward. That's it. That's all you had to say.
I have a question for you,
Stick to script.
If you're in his job, we've observed him a lot, right? That's kind of one of the things we pay attention to here. Do you think that he did it on accident? I mean, there's no way. There's no way that you accidentally slip that in your speech. And so I think, it's
A jab at
in the same speech that he's announcing the end of quantitative tightening. I think it only makes sense that he's going to try to counterbalance it as much as he can, given his role and unique position, which is miserable. But like that's the calculation as far as I can see it.
But I look at it like this. He already hinted that they were going to stop quantitative tightening. And he said it the last time we met with the Fed, when they cut the first quarter, he already stated that they're most likely going to stop that, but he said it was very insignificant. Like it was very small. So he'd already telegraphed that quantitative tightening.
Correct.
stopped.
So even back
did
then,
that
he was
check.
tamping down the bullish sentiment, and now he's
Yeah.
still doing the same thing here.
Yeah. And this is his MO. I know this is him MO. I get it. And it's just frustrating. I know, but I looked at some of the people who voted. I know there was one person didn't want to do any cuts. One person wanted to go a half of a cut, which was actually appointed by this current administration. So I thought that was interesting because, whoever they put in there is going to be aggressive come May. So that should be interesting. I'd like to see this current Fed to basically go ahead and get your quarter point out of the way. Hopefully have another one in January, February, whenever that next time is. And then hopefully at that point, the new ushering in the new chair Fed to basically be a little bit more aggressive would be nice to see. But I know some people had also stated, I know, and you put that out there, Dace. I know there was a post out there about the quantitative, them maybe starting how they want to call it, but it's just another form of quantitative easing by them coming in and purchasing up the treasury markets before rates even get much lower, I should say. So I thought that was interesting.
It is. And by the way, you do have a very good point there, which is that when we're seeing disagreement within the Federal Reserve, especially the Open Market Share Committee, these guys, it's not something that you usually see. And we've been pointing it out for the last couple of meetings now. It's like, oh, hey, somebody jumped ship. Oh, hey, somebody had a different idea. This time we actually had 3 different ideas. We had no cut, quarter point cut, half point cut. And ultimately, I mean, they kind of split the baby on that one and ended up going quarter point cut. But it's curious to start seeing a little bit more disagreement within there. And like you said, yeah, Jerome Powell's time at the Federal Reserve is potentially coming to an end. So it would be interesting to see if they can get a new chair in there that looks like they might be more in line with the rest of the group. I'm not saying you have to be, because I mean, groupthink can sometimes be devastating. And I would like the institution that affects the money supply at the United States not to fall into the hands of groupthink. But again, that might be a little wishful thinking on my part. Got to deal with what we have.
No, well said. I think it's telling that as we move down this curve and closer towards this inflection point, the inflection point being quantitative tightening and quantitative easing, right? In some sort of ebb and flow that in the turning points between those two, right? As you alternate from tightening to easing or easing to tightening, it's only natural that you're going to have some fraying of consensus regarding how best to walk through it. You know what I mean? That's kind of how it would seem to me in terms of why you have those differing opinions from some of the folks over at the Fed.
I mean, we could also chalk up the differing opinions to just the variety of data that's going on, because obviously the second story we're going to cover here is that there have been more layoffs, and we haven't really seen a lot of those, at least since the beginning of the calendar year. And then in addition to that, inflation just went back up to 3.0%, according to reports by BLS. So there's a lot of data incoming, but we just made the transition from we were in inflation controlling, then we went to try to control both, and now we're in trying to stabilize the job market. So that transition only happened 2 meetings ago, effectively, although realistically they kind of knew about it since like late July, early August-ish. But as far as the decisions that they had, they only had 2 meetings. And yeah, I mean, it's just a lot of data. We don't envy these people at all for how much we talk about it. Do you guys think that any one of us would be better off than Jerome leading that ship right now?
Well, yeah, I mean, in terms of like how far down the rabbit hole you've got to go from you and I on the internet to Jerome's job. Yeah, you're talking about a whole nother universe away. It's hard to conceive, but your point is very well taken. No, in a word, no.
Yeah, and
I wouldn't say that, but what I'd say is this is like, unfortunately, right, what I see happening more with the with parties being divided. It's more political than I think being just data driven. That's the thing. That's the issue. If they simply were going off the data and going off it cohesively, then why such a separation? If they're seeing the same data, why this discrepancy so much internally with the panel? Like, why are they so disconnected? I know you look at data through different lenses, it can be interpreted differently, but if they're all coming from the same similar backgrounds with, being experts in the field and understanding how to make proper action, then next logical guess is it's got to be political.
I don't think that's too tinfoil hat to say. I think it's pretty easy to listen you say that and just be like, oh, it's just like team A, team B, red versus blue, yeah. But I think honestly, what a lot of it breaks down to is kind of worldview definitely impacts it, and then also how people view the role of government and what their job is, even though they're technically not government officials because it's a private institution. But I think it still falls in line with that, which is that depending on how you see the role of government and what and what role it's supposed to play in the lives of individuals and also the economy, can definitely affect, in my opinion, how you would act in these kind of scenarios. So obviously the Trump administration is currently in power. I think even the Trump administration is a different beast than previous Republican administrations, which is also a different beast from the average Democratic institution. So I can understand that. And I think it's very real, which is that there is some sort of leaning or bias that comes out, especially with like how you interpret the data, trying to understand what it is. And like I mentioned, they're juggling a couple different data points right now. They got inflation, they got jobs numbers, and they also got like overall economic metrics. And we kind of just crossed that like crossing point of like which one's more important. So I get it. At the same time, I still think it's a tough job, but hey, if you guys want to put your hat in the ring for the next nomination, I'll back it.
Well, it is a tough job, and it's a tough job because of the nature of the construction. I would argue the nature of the construction of the system that the job is in. Like many jobs, man, there are many jobs in this world that I would not want. That, like, in effect, the ideal outcome or the ideal task of the job is noble and worth pursuing, but like the format that it is currently participated in life is like not something I want to be a part of, and so like establishing monetary or fiscal policy sounds interesting, but in the ways that it's currently done now, not so much. It's tricky business.
That's true. And I do try to always point to it whenever I can, which is that the Fed really has two things that they can do to affect the entire situation. It's pretty easy to kind of look at this giant institution and be like, why can't you do more? Why don't you have that single magic wand that can fix all of our problems? And it's like, my friends, I'm here to inform you. They can do two things. They can raise interest rates, they can lower interest rates, or they can buy and sell treasuries effectively. That's it.
Yeah. Well, and look, when you come off of a backing of your fiat, and that becomes the game, there's only so much that organization can do now. Like you said, you really sort of boil it down to a couple of decisions, and there's not a lot of, instead of analyzing the charts, you wind up with interesting statistics and new ways to look at data, and there's true inflation and then there's the inflation they assess, and like those are two very different things, and so you do wind up with fun little wrinkles like that like I don't think help people, but they are an outcome of this current system that we have.
Kind of like the labor market.
Yeah, that one too.
By the way, so we're at 4.3% as of August of 2025. I know this is the reporting we're reading from the Bureau of Labor Statistics that they got, and they reported on today, but those numbers are very low compared. People are thinking like it might be high. It's not. It's very low for unemployment when you look at the grand scheme of things. To put this in perspective, during the financial crisis, 2008, 2010, we were at 10% unemployment. In QE2, that was in QE1, by the way. In QE2, which was November of 2010 to June of 2011, you're pushing 9.6, still highly elevated. QE3, when they did that was that Operation Twist that happened in 2012 to 2014. We were still at 7 to 8% still. So, and then of course COVID, QE4, which was COVID, 14.8%. So we're still very low on the unemployment. So I guess what my concern here is the administration stating that they're looking at unemployment numbers because they're concerned. They want to make sure that stays under control and not get ahead of itself or out of control like it was in these other prior times. Because if that's the case, all right, I get that. Just saying, unemployment numbers in the grand scheme of thing are much lower than they were at those other times when they started doing quantitative easing.
Yeah, but they didn't have robots for sale then either.
Right. That's a whole nother piece of the puzzle. Where is the unemployment a huge threat? And it seems like everybody keeps throwing so much money at AI for all these companies, which I still think is going to end in a lot of losses until they figure out how to properly apply it, like just like, you know, the evolution of Web 2.0. But I think they're, even if the numbers start to go up, they're going to keep leaning on AI as being the silver bullet that they can use to get around that. And that might be also feeding into the fact that unemployment is rising. It's not necessarily stating that it's going to be an indicator of the overall environment of how everything is processed currently, because of the fact you got these new technology that can hopefully stem the need for these companies with unemployment. I know on Main Street it sucks, but on Wall Street and these investments in TradFi, I don't think they're necessarily looking at it as an indicator of being a huge threat yet, just because the numbers are still pretty low in relative terms.
Well, relative to what though? Relative to S&P, we're in a crazy spot, man. It does not look good. If you compare the all of the stock index against unemployment, it's rough.
Not in comparative. If you're looking at the previous years when they started doing quantitative easing, is what I'm referring to.
Okay.
Yeah,
And
that's
so
what I was going. That's what I was rattling off. Yeah, you got to be up towards like 14.8. That's during COVID, during QE1 of financial crisis, which was a liquidity crisis, 10%. The second quantitative easing, 9.0 to 9.6%. And even in Operation Twist QE3, which was in 2012-2014, was still at 7 to 8%.
But in each of those moments, S&P wasn't at all-time highs in those times, was it? There's no way.
No, it was getting destroyed.
Right,
It was towards bottoms.
that's why they were doing it. Right. And so that points to one of two things: either we are on a crazy bubble, or we're at the beginning of a insane run. Right? We've hit serious amounts of expansion. That sure. I think the expansion and separation, honestly, in these two data points is like the core of trying to understand the current market versus the past. Like charts should only show you the history, right? Charts show you the history of things, and like correlating patterns, you can take away some data and hopefully observe and speculate into the future. I think that this break, where like you've said, you're comparing employment in absolute meltdown moments of the stock market to literally the all-time highs right now. That's and we just stopped QT. Like plug those three things into the equation and what comes out, man. I mean, it's a unique situation. You can't find a lot of times where those three variables are in those spots at the same time.
That's true. It's definitely a complicated picture. But Tracker, what were the dates that you had for quantitative easing again?
So in first one during the financial crisis, that was November 2008 to March 2010.
Oh wait, yeah.
November 2008 to March.
Yeah, that was basically when everybody thought. Yeah, that's when everybody thought Armageddon was occurring. This was
that's when Bitcoin
the entire
was born.
banks were going to seize up, and they needed to get liquidity into the system, and then that's when they started, basically bailed out the banks essentially. And then in 2010 to 2011, we were still at 9.0 to 9.6, so still close, pushing to that. We'll say 9.5%, still at that level. So they kept injecting to try to get the economy back going again. But like I said, it was a liquidity problem. Now we don't have a liquidity problem now. Now you have, it's more like you guys were alluding to, the bubble, or more frothy, because markets have already run really far. But then you got to ask yourself, okay, these markets have run far on a chart, it looks like it, but so has the circulating dollar. So is it just we're looking at inflation on the overall markets? That's why everything looks like it's running. That's what it feels like.
Literally look at the pace of the charts since 08. It's a little
overlay that with circulating supply of money.
Right. Well, and that's the thing, like the velocity and the vector, like where they're sending the money and how quickly they're making it, is going to be the new variable to follow in a world where they can just print it whenever they want. Like those variables have to become the core of the thesis, Well,
they certainly are printing a ton of stable coins, that's for sure.
Yeah, that's true. I mean, looking at the charts, it does. You guys, I think you hit it on the head, which is that when we're in the times that we're in now, it definitely looks a bit different than the previous ones, just because there's kind of that extra wrinkle thrown in there, which is like, yeah, we're only at 4.3% unemployment. And I mean, we've been talking about this for a couple of months at this point. Jerome has repeatedly gotten up in front of the mic this year, and he's like, look, I know it says 4.0, 4.1, 4.2. This is a healthy level of unemployment. I'm like, okay, all right, I'll hear you out. But at the same time, I don't think you're capturing everything. And I think that this year has definitely been an anomaly when it comes to the jobs market, which is that traditionally it's the hiring and firing rate, and both of them have been higher in the past. But the issue is now is that the hiring rate has been the one that's really slowed off. And then might as well just bring it up now. But we're starting to see the firings happening again. So layoffs looks like they're starting to happen. Here's a list of companies that have announced for the year of 2025. UPS, 48,000. Amazon, 30,000. Intel, 24,000. Nestle, 16,000. Accenture, 11. Ford, 11. Novo Nordisk, 9. Microsoft, 7. PwC, 56. Salesforce, 4,000. Paramount, 2,000. These are some pretty big players in the economy, and they're all announcing stuff. In particular, this one has a more recent data. Just in pretty much like the last 2 weeks alone, Target had about 1,000. GM, 200 salaried employees, mainly CAD engineers and Michigan Tech campus. Amazon announced it would cut 14,000. UPS announced 48,000. And interesting breakdown, 14,000 management, 34,000 operations. And then Paramount, 2,000 workers as well. And then Ford, 1,200 in its EV factory in Detroit. So our good friend here actually has the other thing I was about to get in here, which is that the timing on this one is also very odd. Because shout out to Centurion 54X, I think he's right on the head with one, which is UPS layoffs right into holidays is crazy. That is right. We're starting November, folks. Next two things that are on the calendar for people typically are going to be Thanksgiving, Black Friday, and Christmas. That's the time when these kind of companies are usually ramping up. So if one of your largest transportation companies is actually laying off a significant amount of the workforce in a time of the year where they're traditionally taking on extra temp roles to help fill just all the demand that they have, it's an odd sign in my opinion. And that's kind of the tail what I've seen for this whole year. It's just we're getting odd signals. I don't know. Call me crazy, but
No, I agree, and I think it's something to watch. And like I said earlier, alluded to, I think it's a sign of things to come. I think technology is moving very quickly, and are we in a bubble on the stock, in terms of like the S&P chart, which is made up of Nvidia and all these other AI speculation stocks? Like I think the answer could be yes, and it still be cut out to really drastically change the job market. I think you could be both at the same time very easily. And you look at some of the developments, it's impossible to factor in that as long as we don't blow ourselves up, like how far can this thing go and how quickly. The technology development curve, makes the parabolic curve on Bitcoin look embarrassing. I mean, it's astronomical, man. When you think about the flip phone I had in high school, things change.
I will put this here. Now, people throw out those big numbers there, and yes, it's a lot of people impacted, and yes, it's horrible for the average person. But when you're looking at the overall companies of that, what's the percentage of layoffs is the big thing you got to ask yourself. Now, some of these are pretty big. ConocoPhillips, that's 25% laid off from their area. Intel, that was 22% of their layoffs. That's 24,000 of 109,000 employees. So those are big numbers. Keep going down. Boeing obviously has had a big cuts. Cisco, yeah, these are infrastructure type plays that seem to be laying off quite a bit. Tyson's Food, Nike, most of these are all at least, in the 12-15% range of their staff, which is 10 to 15% is about normal when you're starting to trim on cutbacks on companies. So I don't think they're all created equal. I mean, even Meta's on here, Google, Dell, PayPal, Salesforce, IBM. A lot of these places are starting to cut back. But I think also that's adding to this is still what I'm going to say is they all keep leaning onto this. Oh, AI is going to fix it all and we don't have to cut staff and stuff. And I think these companies are getting ahead of themselves, just like they did I keep bringing up Web 2, man, because they're going to this is the same thing what they did during back then. Companies were throwing money at this stuff, and then they lost all this money and realized, oh yeah, we didn't do it right. This is what companies do. They chase the new shiny object and they get aggressive, and they realize they're not ready, and then they have to unwind it before they can figure out how to use it in their company. That's what you're going to see again.
I think you had a really good point there. And I come to an argument that I find either kind of fights for or against me in a certain regards. Do I personally happen to think that the overall market is in a bubble, largely AI fueled? I say yes. The reason I would point to it, and here's my double-edged sword, which is that we are really we're running stupid hot on the S&P 500. Amidst that, when back in March and April we had the great tariff debacle, we saw the market correct by, gosh, what was that, like 30% for TradFi? The S&P 500 corrected 30%. Let me double check my math here. Or 25%, excuse me. But then also back in pretty much in the second and third years of the Biden administration, we went down pretty much 30% over the course of 2 years. Additionally, when we had the COVID dip, that went down about 35% pretty much over the course of 2 months. So what I'm seeing in the data is that it has the ability to correct. And if it has corrected for these events, but then still has continued to run to all-time highs, would that be an indicator that it is actually strong? Or would something like that show that these are kind of just flash crashes that bring us down, and that we haven't even seen the bubble pop? And when the bubble actually pops, we're going to see a correction of like over 50% for the S&P 500.
You could see that. I just think it's interesting. When I heard some of the smartest people talking last week, it was I was hearing people, Ray Dalio was talking. You had Kathy Wood talking. You had a lot of Tom Lee were talking. A lot of these guys are smart on their own respective areas, and they all basically saying the same thing. Yes, they think AI is in a bubble. Okay, well that's the technology sector, and that's pretty much been fueling most of this entire rally is the technology sector. Okay, but they also stated that you typically don't get a bubble popping when there's quantitative easing going on. Once this administration were to switch back over to quantitative tightening or raising rates, whatever how you want to look at it, right? Whatever how that looks, whether buying treasury, whatever, that's when you typically get bubble pops. You don't get them popping, based in this game. But like you said, we are in kind of different territories. I get it. There's quantitative easing. We're at all-time highs. Things look real frothy. But you know what? Also, these markets can go for a while before they start to roll over. They don't just find a peak and just dump immediately. Yes, just black swan events. I get it. But those typically are recovered quickly back. And then you have this rolling over process. It typically takes months for it to get digested and rolled over. S&P sure as hell ain't doing that. I mean,
Yeah,
you can make a case
true.
for Bitcoin. You can make a case for a lot of the crypto markets because of you're seeing this rolling over effect. But I think it goes back to what we've already alluded to, and that's the ISM number. That's one big catalyst, that and just a riskier appetite.
Well, we might as well bring that up now. So, for the folks at home, what is the ISM number, specifically the ISM PMI, if you will?
Yeah, so Purchasing Managers Index is a self-reported, basically a statistic that is formulated. I don't know who does it. Business Bureau? Somebody does it. Anyway, they report if they're buying more or less inventory and doing more or less business in the prior month, and then they, aggregate them all. And if you are basically, it's put together in such a way where if the number is over 50, businesses are expanding or doing more business, whether it's manufacturing or services or whichever chart you're looking at. So in this one, it looks like you've got the manufacturing PMI pulled up, and we are at 48.7, which I believe is down from last month. And so, yeah, look, historically, this number is really critical to speculation. If you're looking at it through the crypto lens, which is what we're here to do, all of our really serious altcoin, the others chart follows this chart quite well. Anytime we're above the 50 line, historically speaking, crypto has had really strong runs in its smaller cap coins. And so I keep a really close eye on this number. And I think it's a very clear cut chart that nobody can really speculate directly on, which I like. That nobody can go take out a bunch of leverage on the PMI report. You know, I guess you could. You could call your friends at Polymarket, but like, you know, speculation markets are out there for everything. I'm sure somebody's betting on it, but yeah, I think it's a statistic that historically has proven something to watch when you look back at previous really, really frothy crypto cycles in particular. Yeah, looking at you, Richard Hart and Hex in 2021.
I would expect the PMI is going to start going up once these rates start to take effect. So you've got another 25%. You can almost, I'm going to say here, I think you're going to get another 25 in December. Now maybe it takes a few months for that money to start trickling down to those lower rates. That's going to, and then of course the lower rates heavily benefit small cap, mid cap companies, because that allows them to restructure their debt. And then typically when they have more cash on hand, that's when you'll get more purchasing to try to do more expansion. So that's what'll kind of feed into the whole ISM number if the rates really are going to be a positive traction for companies going forward.
That makes sense. And besides just kind of just allowing time for the rate cuts to get in there, because obviously just because you cut rates doesn't mean everyone instantly changes business overnight. But I think what we have been seeing, especially with these last two rate cuts, is that if we've been following the prediction markets pretty closely, and they were very, very accurate. The one for September, I want to say we closed right before the meeting at about 95% chance on FedWatch. And this last one, we even had a higher at 98% chance. This might be a little speculation here, but I think that when you have that kind of predictive ability of the futures markets, it allows people to kind of front run, or allows the market to bake in the effects before they even take hold or even are announced. So I think that could be one of the things that maybe is pissing off Jerome Powell a little bit, which is why we got him slightly going on the crusade of stop trying to predict what we're going to do. We'll announce it when we announce it, because theoretically, if the market does try to front run this stuff, you might get a diminished effect. You know, is that too crazy to say?
Oh, I don't think, dude. When I can really go on live and bet about what color tie he has on, I don't think it's too crazy to say. How about that?
Okay. Yeah. So yes, look, Jerome Powell did come out. I guess for the folks at home, you don't have to watch the entire meeting or the entire press conference. It was not a barn burner by any stretch of the imagination. There was some good stuff, but there was a good bit of Jerome Powell started the speech by saying the December decision is not made yet, so stop believing that we already have it made. And then multiple questions were surrounding that, and he's like, "You're just gonna have to wait and see." So he was definitely coming out on that one.
So, you know, what's something that's happened since then, late Friday, and then also some more today, is we've had lots of other Fed movements, right? I don't know if you pulled some of those articles, Z, and or not to sort of jump the gun, but it sort of ties into what we're talking about here. We've got maybe some reasons why Fed Powell was nervous to see what would happen to the markets, because they were. But there's no way he didn't know about these things happening. Would you think, Z?
I agree with that. I mean, a lot of what we've been seeing on Twitter that I'm pulling up here is that we're watching the markets to see what kind of injection of capital that we're getting. And this is the exact thing that the Fed does. Granted, we looked at that report that I pulled up at the beginning, the press release. One of the things to remember is that in that press release, they said we are stopping QT December 1st. It is not December 1st yet, and we got a long ways to go until we get there. But even regardless, we are starting to see some movement with the overall markets. And it's the kind of stuff that we've been talking about, that we've been waiting for, which is that it's the actual injection of capital into the markets. So reports that I'm seeing anywhere between 22 to 37 billion. And I don't know what the exact number is, but if I'm getting an aggregate of data that is showing similar data, I'm going to probably just call it somewhere in the middle and just call it like, 25 billion dollars. Is that an astronomical amount of money? No. Is it still a lot of money though? Yes, it is. I don't quite think that this is the injection of capital that we've been waiting for, but it could be a precursor to it. So I think it's important to pay attention to. I think it might be a little bit of front running if you think that this is really going to be the thing that pushes it to towards those all-time highs. But as far as changes in the overall system, this is the time that we're actually starting to see some changes in September, we got the first rate cut, just got our second one here. September, we saw actually like really slowing down quantitative tightening. Today, we actually got the announcement that quantitative tightening is ending, like officially over. That's the big difference on this one. Tell you what, might as well talk about it since I do have the video ready to go. So, gentlemen, please let me know if you cannot hear it.
Just to follow up on the balance sheet,
Can hear it.
if you stop it,
Cannot.
the runoff now,
I can hear it. I was able to hear it the first
There are
go.
differing views on the committee, and to the point where I said what I said.
and just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Well, sorry, Jerome. I think people are already noticing.
Yeah, how interesting. That's wild.
Yeah. This, for me, was kind of like the standout question of the entire press conference. And I think it's the most interesting question that we got, because the rest of it was just like, oh, inflation's up. And Jerome goes, yeah, worried about jobs pretty much. But this one, the guy's asking like, hey, you stopped the balance sheet. There's a chance that unless you make different action, there could be potential negative effects on the banking sector. So you want to elaborate? And he's like, yeah, obviously we'll, kind of bump those reserves up as they need be. But then the thing that he said there towards the end was that we haven't made the ultimate decision for the long-term factor, and it might be a bit of time before they do that. What he's referring to there is the quantitative easing itself, about when it's going to potentially start. He wasn't even asked when quantitative easing was going to start. He elected that information on his own, by the way, meaning that this man's already kind of thinking about it. I'm just saying. Anyways, tell you what.
To me, it's almost like a form of quantitative easing. They're going to shrink their balance, but they're going to also start buying and purchasing. I mean, they're injecting liquidity into the market. That's exactly what they're doing.
Yes, they are injecting liquidity into the market, but it's important to note that this one's kind of for slightly different reasons. So the reason that he's giving there is that if you get the reserves down low enough through quantitative tightening, what you're doing is you're restricting the amount of liquidity that is available to the banks for lending. Theoretically, if GDP growth continues and inflation also continues, it means that you have two upward pressures on your reserves. So the reserves do need to increase. Excuse me, got the hiccups. They need to increase slightly to accommodate for that. If you don't do that, one of the things that can possibly happen is that the banking system actually becomes a little more restrictive. And then even though interest rates might not be getting raised when it comes to the Federal Reserve, you might actually see an increase in interest rates or a harder time getting good credit from the business standpoint. So that's where you see the overall market kind of get affected by this. The answer to this, or the other thing that they could do, is do deliberate quantitative easing. That would, again, more money into the system, more cheap free money, easier to invest, easier to start a business, easier to take out loans, that kind of stuff. But that also means that there's more money in the system, which is the exact thing that we have been looking for when it comes to the potential for extending this crypto cycle into Q1 of 2026 and also getting a decent sized pump towards the end of the year here. So that's where that comes from.
Yeah, I've seen the X post here or there with rumors of like, Trump wants to do stimulus checks for this or that reason, aimed at that same end, right? Anytime you've seen that meme of the dream of stimulus checks, it's with the desire of the outcomes Ian just described.
Yeah. So that was a bit of the explanation of what's going on here. Pretty much the balance sheet that they have there, if they're actually specifically trying to extend it, they're trying to inject more capital, make it easier to borrow. Typically, the times that we've seen this, like Tracker pointed out when we were looking at those charts earlier, those are the times when we're kind of like going through crisis. It's that you can only get the interest rates so low before you have to start going to that second effect there, which is actually injecting liquidity into the system. Right now, we are at 3.75% for the interest rates. There is a good bit of ways to go, especially if we keep going down this quarter-point rate cut plan that it appears that Jerome Powell might be on. I know we talked a lot about he's trying to yell at people for stop trying to predict what we're going to do, but at the same time, he's the man that came out pretty much 2 meetings ago and said that this is the change, this is the start of our new stance. The new stance is working towards what they believe the neutral rate or what they want the federal fund rate to be. What they've kind of been showing with the fact that they had the last meeting and this meeting is that quarter-point cuts is how they're going to get there. So it's really not all that crazy to look at December 13th is our next meeting, by the way, and say, okay, this is the new policy. The new policy is quarter-point rate cuts until we get to the place that we want to be. And as it stands right now, with the potential worsening of the labor market, yeah, sorry, Jerome, I'm gonna kind of count on a quarter-point cut.
Yep. Well, and when the government reopens and some of these other reporting and numbers come in, I think that's going to cause another shakeout. And I think in the meantime, you're going to see, the big exchanges, crypto exchanges, do what they've been doing while some of this legislation has passed and while crypto's been in this developmental stage, which is you just hunt the liquidity, right? I think if you pull up the liquidation heat maps, like we're prone to do over in our Telegram, which you should come join if you have the interest. Historically, over the past year or so, the environment for crypto has been, market makers moving the price in the direction that will make the market makers the most money in the sort of midterm, say 30 days, 60 days in that range. And so something to keep in mind as we move forward into, like I said, the next big government event will hopefully be that our gray government reopens and all the fine people that work for it continue to be able to do their jobs. And so, yeah, I think that will play a factor as we get some of those other reporting and numbers in, and it will cause a good bit more volatility. I don't know when that will happen. We'll see.
That's true. I wrote up a small analysis or theory on the government shutdown and whatnot, and I didn't publish it, but I just wanted to kind of crunch the numbers myself. One of the things I was potentially looking at was, A, the government is the largest spender in human history that the face of this planet has ever seen before. We have voluntarily stopped spending, or all the discretionary spending, if you will, until they can get the government reopened. As we saw pretty much in the last meeting, Jerome Powell did talk about this a little bit. The possibility of a government shutdown does mean a potential GDP growth for the year. But at the same time, because it's self-inflicted, all you got to do is just get Congress together. And, I say that like it's easy, but clearly they're at an impasse, if you will. But once you pretty much clear that hurdle, it just snaps back and you probably see a little bit of a bump up as recovery. But at the same time, you will resume spending as always. That could be one of the things that affects the overall markets and the investment ecosystem, which is, are we risk on? Are we risk off? So that's possible. I'm slightly concerned about seeing some of the larger effects of the government shutdown, especially if it goes into a new record for longest shutdown ever. We're starting to see benefits programs be affected, but based on the data that I'm seeing as it's come in, because the SNAP benefits did end on Saturday, but as it stands right now, based on the data I'm seeing, it doesn't look like it's having a huge effect. I think it can be partly to blame for the very, very small blip when it comes to the S&P 500. But outside of that, I think there are other larger factors at work that we should be paying attention to more. So, yeah.
To add something here. So it looks like the ISM number, the one we've been talking about, normally goes up 3 to 6 months after the first rate cuts. Okay. So if that's the case, then you should start seeing the effects trickling into the PMI numbers, or ISM numbers, sorry, manufacturing PMI, going into sometime around February to April timeframe, which is right in line with Q1 of 2026. So we could be in this rough, just grind it out, shake out as many people wanted to shake out, or people who want to try to get in, position it, and you should start to see potentially the SM numbers starting to go up in Q1. Is most likely what will happen, because it does take 3 to 6 months for that impact to trickle down into the actual business and the liquidity aspects.
Very
And the first
laggy
cut-
data for sure.
And the first cut was last month. So yeah, you're talking about a window from December to March, basically.
Yeah, if you're looking at 3, if you're looking at consider 4, so probably sometime, if I would have had to guess, it's going to be in Q1 sometime when you would start actually having it, probably February at the earliest.
Makes
Yeah,
sense.
it'll be interesting to see how it plays out, man. Look, quickly, I know we're getting near the top of the hour here, but Zenith, we have to pay the piper here, man. We had the 150K call for BTC.
Oh, God.
We came up with the L, with a tough L for October, man.
Hear me out. I went 1 for 2 on that because I really just wanted to put something out there. The one that I was not expecting was the one that I hit. I'm pretty sure I said gold was going to hit 4,200. And yeah, we got over that one.
You're right. You're right. No, that's true. That's true. Let's give credit where it's due. A 50-50, Glad you took the other shot, man. Glad you took the other shot on gold. That's good. You're saving grace.
The great irony is the one that I cared about the least, though.
Right. Right. Well,
There you
maybe you
go.
should invest in the thing you feel, something to be said there about investor sentiment.
Look, was
And
I expecting gold to continue to go parabolic? No. But
No,
it
we
did.
called that one to the day almost, to the top. I mean, give or take a day, we called the top on the gold.
it was pretty wild watching the news stories of people lined out the doors to go buy it overseas.
Yeah, it
That's
looked like
saying,
an
on
iPhone
the day
release
of
or
the top.
something, the way that people were lining up for that stuff. It was
Yeah.
both sides too. Is people that are like, oh man, I gotta buy this, and other people that are like, oh god, I gotta sell this.
Right. Right.
All right, so this is good. I found some other good information. This is really good. So of 7 out of 10 times since post 1990, when they start doing rate cuts, ISM number starts going up positively. 7 out of 10 times. The only 3 times it did not was the 2001 dot-com bubble bust, 2008 financial crisis, and then there's a third one here that technically I don't know if really cut, but this is around 2022 to 2023. But that was the hikes, and we did reverse. We weren't really cutting rates at all, and it was more inflation due to the tariffs that we talked about. But so I don't know if I honestly throw that one out is how I look at it, because it doesn't really. What I'm getting at is the other times when it did not happen. We'll say that, let's put it this way: 7 out of 9 times since 1990, the ISM number has rose. The only times it did not is when we were in extreme recessions or external shocks to the system. .com and the financial crisis. Keep in mind that also includes, I think, when they did quantitative easing to get us out of COVID. So that shot up during that time too.
Well, I was going to say, yeah, each of those 3 times that it didn't, all correlated with 3 of the times that it had the largest liquidity injected into the market that in the modern era. And so,
yeah,
all you have to do is move the frame, 12, 18 months forward from each of those events for some serious parabolic upside in the market as well. But yeah, I think overall it is a sign of the seasons for sure. Something a good seasonal indicator that not a lot of people take a look at, I think.
Like, to me, everything looks bullish. And I'm sorry, yes, the market looks all-time highs. People are like, it's getting too expensive. So is everything else in the world. Like, why would the stock market be any different? Like, everything's getting too damn expensive. Everything's got sticker shock.
We've
So
printed
I don't know.
50%
I think you
of
got
the world's currency in the past 5 years or something. Like, of course everything's going up. What is that going to do?
So I don't know. I think the pain for most people is to the upside than it is the downside. That's what I think.
I'm right there with you. I feel like I'm looking at everything, and all the indicators are telling me we should be bullish because we're finally getting rate cuts. We stopped quantitative tightening. We're getting tons of people getting in on the crypto game, whether it's TradFi that's been doing it for 2 full years at this point, and then we also have a handful of ETFs that also just got approved, and we're getting all sorts of people talking about it and try to get in on it, which means like this theoretically should be the thing. Like we're getting mass adoption, we're getting favorable economic conditions largely. So I mean, granted, we did see two major things that I think are currently hurting us, which is the single largest liquidation event in crypto history, and we also saw the renewed massive trade war with the USA and China. But both those events have been resolved now. So the question is, where are we going? And all the signals are telling me it's supposed to be up, and it's not.
Yeah.
I'm not
Right.
trying to say that because like I want price to go up so that I make money off of my investments. I'm trying to like actually look at the data and see what's going on here. And
Well, it's the market makers, man. It's the middlemen that are eating the supply. You know what I mean? And like that's a big drain in the bathtub. Richard
So
Hart tweeted about it today and tweets about it often. You know, we had a balancer fork was compromised just today, yesterday, I think, for $100 million. I mean, you know, not a small compromise. I think a big, pretty decent size, a very popular protocol. And so, yeah, it's just another reminder. And meanwhile, you've got, you know, other rumors of Binance corruption around the October 10th, you know, the 10/10 events, Wintermute and Binance, and you know, there's lots of mudslinging going on out there in the world of market makers because it's a I'm not going to say it's a dirty business, you know, but it's a business that is controversial and it's as cutthroat as it gets, put it that way. And so when you have high volatility moments, you know, you have lots of feelings, you know, lots of people react emotionally because you're talking about people. I mean, many people in the crypto sphere lost 8 figures that day. You know, I've seen lots and lots of influencers, you know, KOLs and Twitter people that, you know, have lost it all because they had their life savings on a, you know, on a 1.5x on ETH on some protocol that was on the shared Oracle that, you know, flash crashed everything down 70% in 5 minutes, and closed them out on the way down, you know, in terms of their stops. And so like, yeah, I think that's a big problem in terms of why we're not going up more is some of those market maker folks. And so I don't know what to make of that or how to fix it. I know that I like Richard Hart products because there's less of that force there, but it's got its own forces at play. It's a microcosm inside a microcosm. And so, you know, when you zoom down the rabbit hole in terms of the scale, the dynamics change a little bit. That's another whole can of worms, another story. But I say all of that to say, to not mention when we're saying, gosh, scratch our heads, why aren't we going up? That's the big glaring thing in my mind that is holding the industry back in terms of price performance currently, outside of the PMI and some of these other macro forces.
that's
Right.
true. And I know we might sound a little dour on it today. Well, pretty much what we saw was Bitcoin went from pretty much like 109, 110 to about like low 106. But then the rest of the alt market pretty much did a 10% down across the board today. Does it feel good? No. Is it still within the trading range and the consolidation range that we've kind of been in for a few months now? The answer is yes. Yes, it is. So are we shouting that the bull market's over, sell everything, see you guys in 2026? No, absolutely not. It's kind of head scratching because we are sitting back down at the 200-day moving average, which is our long-term indicator, and we're supposed to be in the most bullish part of the season. But at the same time, like, look, I know we say volatility is a feature, not a bug, and that even in the midst of bull runs, we see 30% corrections. It's just when you're in the moment, it's kind of hard to remember that when you're just like, yeah, we were just at all-time highs. Why are we not at also all-time highs? So just keep it in mind.
Yeah,
The
no
market
doubt.
makers are trying to discourage as many people as they can and shaking them out of this market. So what's going to bring, you got to look at it like this. What would be the most painful? What would bring the most pain? How do we shake out as many people? And I'm not saying there's a small group of people here that are trying to plot on everybody. I don't think it's not that straightforward, but I think the market makers are looking at it and they've been making easy easy money by just sniping liquidity left and right around the shorts and the puts. Everybody who keeps doing leverage is getting wrecked. It's almost like you're just handing your money over to these institutions. Like, I just don't know why people are still trying to treat the crypto market like they do in stocks, because there's so much less liquidity. So it's much easier to manipulate and move these markets around. And if you can keep this in a channel, you can just keep sniping puts, sniping, the longs positions, and just make it easy money. And you're just accumulating sideways. Or you'll have these nice little fun, black swan events where you just liquidate everybody and manipulate the rules on the central exchanges. So they could just grind this thing sideways for a while. Who knows? Maybe we grind sideways all the way into going into February, and just to piss off enough people, or people just start to give up and get out of this thing. So I'm done. I'm over this. Or maybe a couple little flash tracks is thrown in there just for good trimming, just to really spook people to get out of the markets. And then as they push more people out, then when there's more to the upside, they're going to let it run to the upside. I mean, TradFi is here and the manipulation's been here. My concern was when the ETFs were coming out. I was really concerned about that, because you're not going to have an organic market anymore. Now you got market makers in here that can really push things around. Keep about it. We're below 4 trillion. That's a very and push Bitcoin aside, right? It very easily manipulate this market, especially if you're not worrying about Bitcoin now. I mean, it's not even a challenge to them. So I think you're going to have more manipulation. I think you're going to shake people and get people frustrated, and they're going to be accumulating. Because it's funny, if you look at the big wallets with the big institutions who have been accumulating since, I don't know, 2017, or even these new treasuries, are any of them selling?
Nope.
Okay,
we're seeing retailers are the ones that are kind of selling right now.
Sure, the retailer are the small guys, and they're getting rinsed out of this market because of frustration. These big institutions and large, equity firms, they have nothing but time. They're looking more at decades, not just this cycle. They're looking at everything. So I kind of the approach I'm taking. I'm taking more the sinister side. What would bring the most pain to shake the most people out, and going sideways and having these flash crashes down would be certainly could do it, and also liquidating people as they keep, as they've been doing since, I don't know, since the ETFs were approved for Bitcoin and Ethereum, and now, of course, Solana and Doge and others. So that's what I'm expecting the institutions to keep going down the pipe doing.
That's true. I guess is some quick stats for you. Yeah, crypto total market cap, I think it's looking at 3.6 trillion right now, maybe a hair under that. Others 3 chart dipped a good bit under 1 trillion as well. And then fear and greed currently sitting about 27. So that's any indication on how people are feeling about it. So, yeah.
Well, let's do this. Bring up the liquidation map. That's always been our little chart. That can almost tell you. And let's look at where the most liquidity. Let's look at where the most chunks are, because that's probably going to tell you where the movement on whether Bitcoin or Ethereum, where the money's going to move, or where price we should gravitate toward. Because that seems to be the reoccurring theme. And if you would just trading around this, you've done really well if you just follow the trades. Since this happened.
Yeah, liquidations are up today. It was mostly longs that were liquidated at about 1.2 billion, almost 1.3. So sense. Is this a large liquidation day? Traditionally, I would say yes, especially after considering we just had, the giant $19 billion liquidation day. So to see it back over $1 billion, is it crazy? No. Is it higher? Slightly high? Yes, it is.
Where's that chart we always look at that I think Dace always shares? The one that's got the nice little bell-shaped curve. It tells us where most of the action's being put on what prices, whether it's the longs or the shorts.
Oh, yeah. I was going to say, this is the one I usually pull up, but this has been forever wrecked by this one single candle that will now throw off the scale forever. Thank you, Dace.
All planned.
Gotcha.
So looking at this or the other ones you have, what does it tell us? What price? Where's most of the liquidity?
A lot of liquidity at that 109 or 109 level. And there's a good chunk of liquidity right there at 105.
So just for everybody here, how do they read this? So would it tell me that there's more puts put on at the 109 level, or are there more puts put in at the, how do I know the difference between shorts and longs, basically?
You pretty much know based on whether it's above or below current price, because what this is showing is the order book. The column on the left, this is kind of our heat map indicator. So The darker color you go, that's the less. The warmer, brighter color you go, that's more money at that level. So we got this band right here, right about that 1085, 1087. There's some bright yellow going on there, and
Yeah,
then
meaning
another.
lots of shorts are currently entered the market at that level, right? So once we broke that level, people entered shorts and are currently sitting short at that 108 level. And if we were to move up, they would be liquidated. If we go down to the 105 level, he's pointing out here under the price. Likewise, those longs would get liquidated.
So I'll take a stab here and just say right now, either we're going to go down to that 105 area to liquidate, and then we start to go back up just in time to liquidate everybody right around the 108 500 area. That's probably where you're going to see price action short term. One of those two. That seems to be the recurrent thing. Rinse and repeat.
That's right. And you can do things like change this chart to its scale from an hour long to a day long to a week long to a month long. And they have all got different data points. So good thing to take a look at.
And what's crazy is during that flash crash we had back when we really dipped down and liquidated everybody right around that Friday on October 17th, there was pretty much no more leverage. It was all gone. Just wiped it all out. And here we are again, people putting everything back on just in that short period of time. Hell, they were doing it just days after. I'm just, the institutions have got to be sitting back like, this is the easiest money all day long. Just liquidate everybody.
Yeah. Oh, completely. I agree. Yeah, between the market makers and the big institutions, I mean, how could you not have a good relationship with retail acting this way?
So if they keep sniping and everybody sideways, just keep sniping the tops, the bottom of the range, just keep sniping everything and keep accumulating more and more. That'll piss enough people off, shake people out, get disgusted, or just get completely liquidated and they don't have any funds at all. Now you just, like you said, the retail side of the house is going to get taken out and institutions are going to centralize more of the supply.
That's true. I guess pull this up real quick. Here's our open interest chart, by the way. This measures how much, betting is going on with the longs and shorts. We can see here was our big liquidation event. We were sitting about 43 billion at the time, dropped all the way down to 31 billion. And then it's picked up and gone down a little bit, but we're still kind of sitting at those lower levels. So it has not returned to where it was, but at the same time, $32 billion in open interest positions, still a good chunk of change. Yeah. Yes. Alrighty. Tell you what, gentlemen, I think we beat it up good enough for tonight. So with that being said, it's time for everyone's favorite part. So folks, if you enjoyed the show and you want to get more information, you want to keep the conversation going, or you want to catch some of our exclusive live streams, you got to join the Telegram. That is where we put all of our best information first. And if you have any specific questions for us, please ask away. All of us here are more than happy to hop in there and answer them. But like we say around here, the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&A, go from beginner to intermediate to expert with us. And when we all work together, we can all win together. And let me tell you, there's plenty of room for everybody on this ship. So we'd appreciate if you hop over there. But at the same time, regardless, even if you don't, you can still catch us every Monday, 8 p.m. Eastern time, where we're going to be here talking about what's going on, trying to make sure that we break everything down for the folks at the high levels and the low levels. Yes, we did talk a lot about the Federal Reserve today, but I hope we made it clear how their decisions, and particularly their decisions when it comes to the balance sheet, can actually affect what goes on in the overall macro ecosystem and ultimately the crypto markets. So that is what we got. Dace, before we get out of here, any final thoughts? Where can the folks find you? What do you got going on?
No, I had a great show, man. You can find us at, like you said, Walk the Block, and you can find me at Dace Northall on Instagram and on X. I don't think we have a Walk the Block Instagram, but we are over on X.
Yes, sir. Tracker, over to you, sir. Any final thoughts, and where can the folks find you?
Don't get shaken out of your positions. Sit tight. If you have to trade anything, I would say one thing that I'm doing, I'm just taking 15% of my portfolio, maybe given on what extremes we get to, and using that to kind of trade around positions. While we want to grind sideways, I want to capitalize on this grinding sideways, but overall, holding on my long positions and just let I'm not shaking out of those positions. I'm not buying it that we're going to get everything's over. I think you just have to go through this rinsing process. And that's what we're going through, and letting the institutions kind of just gobble up all the liquidity. Just Don't do leverage. God, it's a sucker's game right now. Don't do leverage.
Yes.
I mean, they're just sniping people. It's not even fair. You're just handing your money over at these. Yes, you might get it right. And kudos for those who can pull it off, but very low probability you're going to have a success rate. Hold longs if you want to do any trading. Just keep it to a small minimum of your portfolio, and just grind sideways. And let's just wait and see how this thing's unfolding. I think still with all this stuff coming, like we pointed out, it's going to take some time for those rate cuts to start transitioning into the actual movement of liquidity and purchasing power for these companies, certainly the small cap ones, and that should trickle down into the more riskier assets. Just stick to that. Nothing's changed. If you guys didn't catch the show last week, I'd recommend you guys watching the one last week. We dove into why gold was rallying, why it was relabeled a different asset, which is a huge change for balance sheets people. And that show really went into the whole macros with why gold's moving and why that could translate into the riskier assets. And also was another backdrop of probably another thesis that was in those discussions between the Trump administration and China during those tariffs. So I'd highly recommend checking that out if you didn't check it out. Outside of that, we're over in Walk the Block and in our Telegram chats for our members, just trying to keep everybody plugged in. Right now, it's just kind of basically just riding this, but that's probably my best advice I can give you. If you want to trade a little, but just hold your longs.
Love to hear it. Yeah. Last week was a great episode, by the way. Good one for all the folks out there that like to know more about gold or just kind of interested in the international diplomacy and economic warfare that goes on with currencies. That was a fun one. I had a blast with it. But yes, outside of that, we're going to be back next week talking about whatever it is going on. Hopefully it's not more liquidations, but at the same time, if it is liquidations, I hope we liquidate those shorts and keep moving towards higher positions. We are in the end game. It is officially November of 2025. November 10th of 2021 was our cycle top last cycle. We're not huge on measuring top to top from the 4-year cycle, but at the same time, it's been a pretty decent estimate actually. So keep a weather on that horizon. Don't get shaken out of those positions. If anything, I mean, like right now's the time to be in it. This is what we've been waiting for years. So to everyone that's been sticking around this long, kudos to you. We're not done yet, but at the same time, please keep in mind, you got to make your own decisions. Nothing we say here is financial advice, but I'll say I'm looking forward to the future. And I don't think I'm too crazy for the 150K Bitcoin call. Thank you, Dace, for reminding me of that. Feel free to call me a charlatan in the chat because it has not manifested yet, but hey, I got 2 more months on that one. So, it can happen.
Look, Tom Lee says we're still hitting 200K Bitcoin by the end of the year. So you're undershooting Tom Lee. So there's that.
Yeah, if people start calling me out on Twitter, I'll just start forwarding them over to Tom Lee and be like, look at that guy.
Well, just to add to it, just everybody think here for Ethereum. Ethereum's now trading in this kind of down sloping channel. We're at the bottom of the channel now. So if anything, we should be bouncing off of this to at least start moving back up again. I think we could stay down a little bit more. But honestly, I remember when Jay was doing the 60-day cycles and everything, and we expected the lows to be any time between October 19th all the way until November 15th. So if we're coming at those cycle lows, we're coming in right in there at those cycle lows, which is right along with what we expected. So that's good as well.
Yeah, it's true. As the count stands right now, I think we got a shorter 60-day cycle that ended up at 46 days. As it stands right now, if we assume that the low for that cycle is not in, we're only on day 64. So it's still within the realm of possibility, especially since the cycle high was on day 35, which is after day 30, which is typically an indicator it's going to run long. But at the same time, because we had the drop down to 103 and then our move back up to 115, that is a bit of a confirmation for me that it's a new cycle. But at the same time, the chart's going to do what the chart wants to do, not what I want it to do, because I wanted something else, let me tell you. Alrighty, that is all. Please go for it.
No, you're good.
Just got to get one last jab in there at me. That's fair.
No. You did a great job, sir. I wanted just as bad as you do. Trust me, brother.
I know. Fair enough. Alrighty, folks. Thank you so much for joining us. I thought we had an excellent show. Always a pleasure. We love the Federal Reserve events. If you asked one of the AI models about there, what do we talk about? They wouldn't tell you crypto. They'd tell you Federal Reserve probably. But we think it's important, and it definitely affects the crypto market. So we're going to be talking about all that and more into the future. Always appreciate you having us with us for the journey, and we hope to see you next time. Good night, everybody. Have a good one.